Good evening, everyone. Thanks for coming. We're going to give a couple minutes here for others to join. But in the meantime, if you'd like to put in the chat what part of Arizona you're looking to buy a home in, that would be great. No obligation. Do a lot of business in Mesa. That's a good spot.
A lot of variety in Mesa as well.
Definitely. Phoenix. That's where I live, Phoenix. Brandon's over in Scottsdale.
Yeah.
Anyone who just joined, if you want to put in the chat what part of Arizona you're looking to buy a home in, that'd be great. We're just giving it a couple minutes here for others to join before we get started.
And it's funny, a lot of times we think, each market is the exact same, whether it's Mesa, Phoenix, or Scottsdale, or wherever it is. And um, a lot of the tools that we have show which way the market's leaning, whether it's a buyer's market or a seller's market. And different pockets sometimes have different criteria. So it's kind of cool to look at and see what your specific area looks like.
Yeah, and especially when it comes to inventory available
Hmm.
and things like that.
Yeah.
All right, well, we're going to get started here. Basically, the purpose of this first time homebuyer webinar is to give you a practical walkthrough from, where do I start in this process, all the way to what it'll look like when you get the keys in your hands to buying your first home. Most first-time homebuyers have a lot of questions about the process because they haven't done this before. So this should give you a really good idea of what to expect throughout. All right, I am Peter Seroter. I've been a loan originator since 2001. Yes, I'm that old. I'm licensed in 7 states right now, and I've closed thousands of mortgage loans in my career. And I specialize in working with first-time homebuyers like yourselves and veterans. I'm a veteran of the U.S. Army myself.
Hey, everybody. I'm Brandon Childs. Thank you so much for joining tonight. I'm really excited to help educate you through this process and hopefully help navigate the home buying process with you. I've been in the industry just over a decade. So I'm currently licensed in 3 states, and I've helped hundreds of families become homeowners. And everyone is a little bit special in its own way. So it's really cool. I really enjoy what I do. I specialize in helping first-time home buyers, and I also help a lot of real estate investors. Um, my key thing is I really want to educate you through the process and make sure that you are well informed from start to finish. So I think Pete can attest that's our main priority here is to make sure that you understand the ins and the outs of the entire process.
Absolutely. And if you want to take note, you've probably received some text messages from us here to get to this webinar, but that toll-free number there will be the number that you can reach out to us at. You can text to that number, and if we reach out to you after this webinar, that will be the number that we're going to be calling from as well.
Yeah, and throughout this webinar today, I'm going to be sending some messages in the chat. So keep an eye out. As we're getting through, I might ask some questions here and there. But really, the more interactive you are in this, the more value it's going to bring for you. Chances are, if you have a question, somebody else has the same exact question. So feel free to throw any questions that you have in the chat at any time. I'm going to be monitoring it the whole time. So if I see something come up, I'll make sure that we touch on it.
Thanks, Brandon. All right, so how to use this webinar today. This is going to be general education. We're not lawyers or CPAs or tax advisors or anything like that. So basically, this is coming from the standpoint of mortgage loan originators, Brandon and myself. We're going to be discussing loan programs and guidelines, and those vary by lenders and they can change from time to time. So, it's important to kind of realize that there's a lot of options that are out there. So we're going to give you a good overview of what's available to you. Bring your questions. If it's confusing, that's totally normal. First-time homebuyers have a lot of questions, like I said before. And you'll leave this webinar with a clear next step plan. Even if you're 6 months out before you're looking to buy a home, you'll know what things you can start working on today to help you get ready for that. So the agenda is going to be first, we're going to discuss the benefits of home ownership and some of the trade-offs that nobody likes to talk about, some common myths and the real rules of thumb, the loan types that you'll actually see as a first-time homebuyer, which are typically conventional loans, FHA, VA, or USDA. What lenders need to qualify you, the for your credit, your income, your assets, and any debt that you might have. Also, the step-by-step process from pre-approval to making an offer to closing and some tips to save money and reduce some stress during the buying process and avoid the common mistakes that most first-time homebuyers unfortunately make.
So, just out of curiosity, I know a couple people responded on where they want to purchase, but feel free to throw in the chat. How quickly are you looking at purchasing? Are you looking to buy in the next 6 months to a year? Are you actively searching for homes now? Or, I mean, are you even under contract already? Where are you in the process? And this one might be a little bit easier too. Feel free to throw in the chat. What is the biggest concern that you have when it comes to home buying? Are you more concerned with, coming up with the down payment or closing costs? Are you concerned with or your credit score or any debts that you're currently carrying? Is there things that you need to pay down, or what is it that's holding you back from pulling the trigger on the home purchase now? Oh, 6 to 12 months. Okay, awesome.
Yeah, that's a good time frame, Miriam, to be doing this right now because most of the time there's some things you want to kind of get lined up beforehand. Down payment. Yep.
Okay.
Yep, absolutely. Well, we will touch on all of these things for you. Thank you so much for letting us know here. All right. So the financial benefit number one, building your net worth. There was a study done a couple of years ago that a homeowner's wealth is actually 40 times higher than a renter. And that happens from two different reasons when you own a home. Obviously, appreciation over time. That means that real estate will go up in value over time. Obviously, that is an asset that you're holding, so you are gaining wealth by your asset gaining value over time. In addition, when you make a monthly payment on a mortgage, unlike your rent, you're actually paying down the amount that you owe. So that increases the amount of equity that you have as well. And I love this chart. It might be a little bit hard to see, but what this shows right here is the second financial benefit that real estate always appreciates over time. This shows since 1942 all the way to 2024. And actually, 2025 was also a positive year. But of these 82 years here, there were only 6 years ever that national home prices decreased. And that 5 of those years were during the Great Recession. And hopefully you didn't own a home or weren't didn't have a family member that had struggles during that time, but that bubble was fueled by loans that were being done that were really risky. And they were loans where people didn't have to verify their income. They could finance up to 100% of the property. They were just really risky loans that were done, and it caused a crash in the market. Since then, the whole process for getting a home loan is extremely regulated. And people who own homes today typically are going to be very very comfortable with their monthly payments because the qualifications to get a home loan are very strict. And it's always you're always going to verify your income. You're always going to have a certain debt to income ratio to be able to qualify. So the home loans that are done since that bubble, which was really that 5-year period where home prices went down, have changed dramatically. And in looking at this, you can see there are years of 20+% gains in value. There was in the 40s, values went up 24% in 1946, 21% in 1947 the year after. And then recently, after COVID, we experienced that where in 2020 values went up 10%. Then in 21, they went up 19%. So people that bought homes prior to COVID, for instance, they've seen their home value double since then. So being in a home for a long period of time, especially if you plan on staying in your home, it's a great way to build wealth over time and it will always appreciate. So home ownership, the benefits and the trade-offs. The benefits, obviously, they're going to be stability. When you're renting, ultimately, you don't know where you're going to be year to year. You can't really have that long-term plan when it comes to renting. When you own, you control your space. You can make it the way you like it. You can paint it what you like. You can do your backyard the way you like. You can really customize it to what your family desires. And you'll gain equity over time and you have options for to plan long term. Now, the trade-offs to owning a home is that you have to maintain it. You can't just call the maintenance guy up. He's going to come and show up in a couple days and fix your leaky faucet. So there's things that you need to have to, either get handy or you'll have to hire people to do those types of little repairs when they happen. You have taxes, you have insurance that you have to pay for. And when you want to move, when you own a home, it's not quite as easy as when you rent. You have to sell that property. So there's a little bit more involved in that when you own a home. Brandon and I say this all the time when we're asked, when's the right time to buy a home? It's when you can afford it. That's the right time. If you can't afford it or if you're struggling, living paycheck to paycheck and things like that, it's definitely not a good time right now to buy a home. But when you have the income for it, you have the stability in your employment and things like that, it is a good time. And if you plan to stay there a while, as we saw in that previous chart, really the benefits of home ownership come over time. If you're planning on buying a home and living there for a year or two, it probably doesn't make sense to do that. And number three is that you have a buffer. If you're living paycheck to paycheck right now where you're renting, oftentimes you're going to really struggle when you become a homeowner because things happen. These repairs and maintenance things, they happen. And it's just a fact of life when you own a home. So you want to make sure that you have a bit of cushion or margin in your budget. And it's important to know that you're not behind. If you're building the foundation for home ownership, if it takes 6 months, 12 months, 18 months, 2 years, whatever the case may be, if you're setting all of the proper stages in place when you're ready to buy a home, you're going to be that much better off when you do it. The idea is to set you up for success. Here are some of the myths that you might hear, and these are ones that might come up like on holidays when your parents are talking or grandparents, and they'll say things about owning a home that, they're just not true. Like you have to have 20% down when you buy a home. That's definitely not true. You can actually put as little as 3 to 3.5% down with most first-time homebuyer programs. And in some cases, if you're a veteran, or buying a rural property and you can do USDA, you can even put 0% down. Myth number two is I need perfect credit. Well, the reality is there's a range of loans based on your credit score, and some programs go as low as 500. Typically, the best scenarios are 580 or higher, but you can actually get down as low as 500 for a home loan. Myth number three, student loans mean that I can't buy. That's definitely not true. Obviously, they affect your debt to income ratio, but if you have student loans and you can afford those monthly payments and you can afford a mortgage, then you can buy. Those student loans don't keep you from being able to buy a home. And the fourth myth is my payment will never change. Well, even if you do a fixed rate mortgage, your payment will change over time. And why is that? Well, it's because of the taxes and insurance on your property. Most mortgages have your taxes and insurance lumped in on your monthly payment. So if your taxes go up each year, your mortgage payment will go up accordingly. Same with your insurance. Now, when your insurance goes up, you do have one benefit that you don't have with your taxes. You can actually shop around insurance companies and get that sometimes lower. But when it comes to your taxes, when they go up, there's nothing you can do about that. So you have to assume that, there's going to be a slight change in that payment from year to year for your taxes.
So, and this is one where it doesn't matter who I work with. These questions always come up every single time. So if you wondered any of these, you're completely normal. These are ordinary questions that we hear all the time. So how much house can I really afford? And that's where going through the pre-qualification is really going to help you determine the monthly payment that you're able to afford. And then working with a professional, we're going to determine, okay, yeah, maybe you can afford this payment, but is that going to help your budget or hurt it? So we want to make sure that we're understanding your full scenario so that we can put you in the best position possible so that you are successful as a homeowner. Um, what do I need for a pre-approval? And we'll get into a pre-approval versus a pre-qualification here shortly, but um, when it comes to the pre-approval, we're looking to verify income, verify, your job, make sure that it's stable, make sure that you do have those assets for either down payment, closing costs, or reserves. Um, and how much are closing costs? On top of a down payment, you should anticipate, I would say between 2 and 4% for closing costs, and that can range as well. A lot of times when you're looking at closing costs, it varies on where you're buying. Um, Different cities have different tax rates. If there's an HOA, there's a lot of variables that go into what can be considered as your closing costs. And then you have your prepaid items on top of that, which are your property taxes and homeowners insurance. So, all of these things are what we need to account for when it comes to your out of pocket expenses at closing. Um, Now, this one's huge. Uh, do I need an inspection? So, when you're buying a home, I always recommend you do an inspection. As a lender, we don't need you to do the inspection, but we always, always, always recommend it because the last thing you want to do is um, get into a property and you have the appraiser come in and he's going to give an opinion of the value of your home, but he's not going to do a sewer scope. He's not going to look at the bones of the property and see if there's anything that can cause you headache down the road. So an inspection we always recommend. And how do I pick the right realtor? You know, eh, because we've been doing this for so long, the good thing is we have a network of realtors that we know and trust, and we can always give you a great referral for somebody. If you're working with somebody now, that's always great. But we do have a lot of great referrals that we can help get you in touch with there as well. And how do I pick the right lender? There's a wide variety of different kinds of lenders. Peter and I, as mortgage brokers, we have a leg up on the competition because we're going to be able to shop your loan around and make sure that we find the right fit for your scenario specifically. We're not tied to just one set of guidelines. For example, if you get qualified through Bank of America, you have to qualify to what Bank of America says that you need. Versus when we do your pre-qualification, we can shop over 180 different lenders to figure out who fits your criteria best and who is going to get your scenario across the finish line. So picking your lender is something that we're going to help educate you on. As far as stress points, these come up all the time. Again, like down payment versus closing costs. Um, when your down payment is your minimum skin in the game, you have to come in with this amount, whether it's money from your own pocket, maybe you have a retirement account that you want to pull for your down payment. Um, that is set in stone. That's going to be the 3 to 3.5% as a first time home buyer. Um, then you have your closing costs on top of that, which contribute to your cash to close. So we'll get into that as well. And then the fear of messing up underwriting. A lot of times it's, people get concerned and they get caught up with, well, what's the underwriter going to think about this or that? And that's where upfront, when we do your pre-qualification, we're very thorough And once you go under contract, we'll lay down the law. These are the do's and don'ts of what to do when you're under contract. You don't want to make any changes to credit. You don't want to buy a new car or finance new furniture before your closing date. So we'll get into underwriting as well and kind of go through some of those details. Um, and a big one, a big stress point is not knowing what's negotiable. And that's where working with a realtor or a professional, somebody who does this regularly, is going to be very helpful in the home buying process. Sometimes, we think, oh, I have a cousin that was a realtor and they bought their own home using them as a realtor, but I want to use them too. Well, if they've only done one transaction in the past 3 years, it might not be the best source. And that's where we can kind of walk you through and help you find the right fit to help make sure that you're taken care of and prepared the best you can be.
Yeah, good stuff, Brandon. And I don't know if you actually even saw this going around social media actually last week, where the National Association of Realtors put out that stats on realtors across America, and actually 70% of the realtors didn't close one transaction last year. So just because, Aunt Betty has a real estate license, it's probably not the best person to help you buy your first home, because you really want somebody who's in tune with the market, and knowing how they can negotiate on your behalf. And one of the things that's really popular right now is getting the seller to pay some of your closing costs. They can't cover your down payment, but they can cover your closing costs. So having a really good realtor who understands the market can help negotiate on your behalf and save you $10,000, $15,000 out of pocket with that.
Mhm.
So it makes a big difference. So these are the loan types that you're going to see most often. First, the most common loans, 70% of loans that are done are conventional loans. These are backed by government entities called Fannie Mae and Freddie Mac. Basically, these government entities purchase mortgages to make home ownership available across the country. They are very, very well priced, but they're also a bit more conservative in the underwriting. So they tend to be for a little bit more experienced home buyer, or someone who's maybe has a larger down payment, or maybe it's the loan that you would do after you've been in your home for a few years. That's why it's so prevalent to do a conventional loan. Not a lot of times is a first-time home buyer doing a conventional loan, but as we talk about the next one, which is the most popular for a first-time home buyer, you'll realize why you would want to move into a conventional loan. Notice where it says PMI is required if you put less than 20% down. So the reason why you heard that myth that your grandparents talked about with putting 20% down is because if you put less than that, you have to pay something called PMI, which is private mortgage insurance. And that mortgage insurance essentially protects the lender if you were going to foreclose on the property. Because there's not a lot of equity there, if the lender has to sell the home at a discount, they would lose money. And that insurance protects them. So if you put down a larger down payment, then you don't have to have that. But if you don't put down 20%, that's where that mortgage insurance comes in. The most common type of loan for a first-time home buyer is FHA. Now, that stands for the Federal Housing Administration. This is subsidized by the government to make homeownership available for first-time home buyers. So you only have to put 3.5% down with an FHA loan. You do have mortgage insurance always required on an FHA loan because you're putting a smaller down payment, essentially, and they're absorbing a lot of risk. So with a traditional type of FHA loan, you can go as low as 580, and in some cases down to 500 with them as well. If you put down 10% or more, you can do an FHA loan down to 500. With 3.5% down, you can have as low as a 580 credit score with that. And an FHA loan has really good interest rates. Even though you might not have the best credit score around, you'll get a lot better interest rate on an FHA loan than you would on a conventional loan. However, if you've been in the home for a number of years and you've gotten your credit really, really good and you have at least 20% equity, then it's a good choice to be able to get into a conventional loan, because then you can drop off the mortgage insurance that you're paying. Then the next one is a VA loan. These are excellent. These are for any veterans or service members that meet the criteria for these. And you do not have to have a down payment with those. And there's no mortgage insurance required at all with a VA loan. So I see in the chat here, Rocket Mortgage told you 1%. Yeah, so there is a program for conventional that you can put 3% down. Rocket Mortgage is essentially giving a 2% lender, like kind of like a bond or a grant to cover the other 2%. So it's a 3% total down payment for that.
And also, there's limits, right, with the 1% down. If you're buying a $700,000 house, the 1% program might not work because there's limits to how much they're willing to give to cover the additional 2%.
That's right. That's right. And then this one is not very popular, but it's an awesome loan program, USDA. If you want to live in a rural area, then a USDA loan is awesome because you can put down 0% on those, and it has very small mortgage insurance as well. So a conventional loan can be as low as 3% for a first-time home buyer. Basically, you have to have certain criteria that you have to meet for this, however, but you can put as little as 3% down and you do get discounted mortgage insurance with that program if you qualify. If you put more than 20% down, you won't have PMI. But if you put less than 20% down, you will have PMI. Either it's included in your monthly payment, or there are some circumstances where you can prepay your mortgage insurance up front so you don't have it as part of your monthly payment. An advantage of a conventional loan is if you're in it for a number of years and your home value goes up and you have 20% equity, then you can get that PMI removed. So, for instance, if you bought in 2019 and then COVID happened and home values in the valley here in 2 years went up 30%, then all of a sudden in 2 years you got 30% equity in your property and you don't have to have PMI anymore. So it's a great advantage of a conventional loan that will just fall off and you can have that removed from your monthly payment. And like I said earlier, if you have strong credit and a stable income, conventional loans are a really good option. FHA loans can be as low as 3.5% for the down payment. The mortgage insurance is actually less than what it is for a conventional loan with 3% down or 5% down, or sometimes even 10% down is comparable to what an FHA is. So it's pretty affordable. And it works really well with first-time home buyers because you can also get gifts to cover those down payments. You can get a larger amount of seller credits given to you to help cover the closing costs. There's some nice perks to go along with an FHA loan. So it's important to know with any of these loans that we talk about, like one's not necessarily better than the other, maybe VA, but outside of that, one's not necessarily better than the other, but there's going to be a right fit for each person. Every person's scenario is very different. So yours is going to be different than the next person if you have a different credit score or a different amount for your down payment. You're buying a different type of home. All of that can play a part in the type of loan that's a good fit for you. All right, and VA loans, you don't need a down payment. So that's a huge advantage with them. There's no mortgage insurance. So not only do you get a below market interest rate, you don't have any PMI at all. If you don't have a disability or a disability rating through the VA, you do have what's called a funding fee. That's kind of like in mortgage insurance, but you pay it one time up front. It's fairly expensive. So, that's how VA basically protects that program. That if, again, a veteran goes into foreclosure, that funding fee is basically an insurance that pays the lender back for that. And you want to talk to someone like Brandon and I, they do a lot of VA loans to structure those properly. It's really, a loan that you don't want to go to a lender that doesn't do a lot of them because there are a lot of nuances to VA. USDA, that's the United States Department of Agriculture. Like I said before, you can finance up to 100% with those. There is property and income eligibility. You can't make $500,000 a year and use a USDA loan. There's just certain property types that are eligible. You do need to be in a rural area. And if you just Google USDA eligibility map, you can actually plug in an address into that map. So if, let's say that you wanted to live like somewhere south, like below Casa Grande or somewhere like that, and maybe between Phoenix and Tucson kind of deal, then that might be USDA eligible. So you can look on the map there, and if it is, then you would be eligible for this program.
We have a really good question here in the chat if you want to address it here.
Any
Any,
amount more than 3.5% down, does it have a good effect on the chance to get a loan? Um, the more you put down on a loan, the more kind of forgiveness that you get. So if you have some blemishes maybe on your credit, putting a larger down payment can be a compensating factor to help you get qualified. So yes, that does play a part. You don't have to, because again, FHA is pretty darn forgiving. But
Mhm.
if you have maybe like recent collections or a judgment or something like that that's fairly recent, putting a larger down payment can help you be able to get approved for that. Good question. Okay, so these are the things that lenders are going to use to qualify you. Your credit. So basically, your score is one component of it, but really what a lender is looking for on your credit report is your payment history and the amount of debt that you're carrying. So the payments also are going to show on there for the debts that you have. One thing that's a real common misconception is if you have a student loan, for instance, in deferment and you're not making a monthly payment on it, that still does factor into your debt to income ratio. Basically, depending on the program, we have to use either at 0.5% or 1% of the balance of that student loan as a monthly payment against you. So, same if you have car loans, credit cards, all of those things are going to add up and affect your debt to income ratio. For a credit card, what is going to show up is going to be your minimum monthly payment. So, maybe you pay extra on it every month. That's great. That's not what we would use to count against you. But if you look at your statement, it'll show the minimum monthly payment. That's what's factored into your debt to income ratio. Your your income. The biggest thing is that first word, stability. It's really important to have the same similar type of income that you're receiving, whether you're W-2, if you're commission based, bonuses, self-employed. You really need to have stability in that. W-2 is the most flexible. If you're just straight salary, you could kind of move jobs, and as long as you stay salary, that's pretty straightforward. Really, where the challenges come in for a lot of people is if you have what's called variable income. And that would be like if you get commission, you're a car salesman, and you went from one dealership to another dealership to then selling boats and then motorcycles, and you're selling these things, but that income that you make is commission based. So when you change employers, then you don't have stability in that income. So you typically need 2 years to be able to use any type of variable income. Your debts, like we talked about, your assets, your funds for your down payment. Those are going to be verified with a 2 month history in your on your bank statements. So if you have a down payment that you want to put down, then you want to supply bank statements, and it's going to show that you've had that money in your account for 2 months. Now, if you all of a sudden a week before you want to buy a home and do a mortgage application, all of a sudden get a deposit of $50,000 in your bank account, that's not considered seasoned unless it came from your job or somewhere that you can document. If all of a sudden you just got that money and it's in your account, then it has to be in there for at least 2 months before you can use that. And then the property itself, the appraisal value, the condition of the property. And that's important when it comes to those government type of programs like VA and FHA specifically, those government-backed programs are the strictest when it comes to the condition of the property. They have like health and safety restrictions. So simple things like if you want to buy a home that's a bit of a fixer-upper, let's say, and it needs like, um, has a broken window or it has paint chipping off the walls or it's got light socket covers that aren't put on or just little things like that. FHA or VA is going to require the seller to fix those things before you're able to buy the home. Okay, so for your credit, here are some things that you can do over the next 30 to 60 days that to help get your credit on the right track if you've had some struggles. Obviously, you want to pay every account on time. Late payments weigh the heaviest against you. Next, you want to keep your credit card balances low. So the rule of thumb is if you can keep your credit card balances under 30% of the limit, you're going to get positive points towards your credit score. If you keep it between 30 and 50% of the limit, it's not going to affect you one way or the other. If you have more than 50% of the limit on that card, you're actually losing points for it. You want to avoid opening new accounts right before you want to buy a home. So you don't want to do a balance transfer on a credit card and open up a new credit card right before you want to apply for a mortgage. That's going to lower your score as soon as you do that. If you want to get a new car, you want to wait until after you buy the home. Because when you go buy a car, you go to the dealership and they'll pull your credit about 15 times because they're going to try all these different car loan companies to try to get you whatever interest rate on it, and that affects your credit, all those inquiries on there. So you really want to kind of lock your credit down and be very careful with it in the months prior to buying. And you want to shop mortgage offers, but it's good to know that within a 45-day window, if you get your credit pulled by Rocket Mortgage, let's say, you can also talk to Brandon and I, and we can pull your credit if it's within 45 days, and it still counts as just one inquiry. Or you could have it pulled by Bank of America, Wells Fargo, US Bank, all of those things, all in a row, and it's still just one inquiry, as long as they're all mortgage inquiries. But if you go to the car dealership and they pull your credit, and then you go and apply for a credit card, that's another type of inquiry, and then you go get your mortgage credit pulled, those are all three different types of debts that you could be getting. So those are going to lower your score. All right, the DTI, debt to income. So your debt to income ratio compares your monthly debts to your gross monthly income. So when you apply for a mortgage loan, it's not going to be your take home income that is used. It's your gross monthly income. And from that, you're going to subtract any debts that you have on your credit, not your cell phone bill or car insurance or things like that, because those aren't on your credit. But things like car loans, your student loans, credit cards, personal loans, and then the house that you're going to buy, those are all going to count against your income. And the rule of thumb is the lower your debt to income ratio is, the easier it's going to be to qualify. However, for most loan cases, you can get up to 50% of your gross monthly income going out in debts. So let's say you have a total household income of $10,000 a month, and you have a two $500 car payments between you and your spouse. That's $1,000. And then you have credit cards of $500 a month. So that's $1,500. So out of your $10,000 income, you can have $5,000 worth of total expenses. So that leaves $3,500 for your house payment. And that would include your property taxes, insurance, and HOA if there is one. All of that has to fit within 50% of your gross monthly income. Now, the reality is that if you go up to 50% debt to income ratio, money is going to be very tight. Gross. Think about gross. You're not bringing home your gross. You're paying your taxes, federal taxes, state, social security tax, and maybe taking something out for 401k, health savings, like that stuff's coming out of there. So it doesn't leave you a whole lot of room for gas, for food, for entertainment, things like that. So that 50% number, you can do it, but typically it's not going to be comfortable. Okay, so for your income, this is what counts for income and how it's averaged out. So the easiest for anyone is if you're just straight salary or hourly. And in hourly, one thing going back to what I mentioned earlier about stability, it's important to have consistent hours. So for example, if you say that I make, $20 an hour and I work 40 hours a week, and then we get the pay stub and it averages out to 35 hours because we're going to do the math and see how much you've made in that 2 week period or 1 week period. And it needs to, if you say 40 hours a week, you need to have at least 40 hours on there, or they're going to average what you actually did work. So even if you're scheduled for 40 hours, but you only work 35 typically, then that what you actually work is what will be factored in. And variable income, like I was mentioning, that's going to be like if you get a bonus or overtime or commission. So let's say you just get a brand new job and prior to this, you didn't get a bonus in overtime and commission. So great that you did that, but you don't have a history of that. So this great new job is going to pay you, a $10,000 bonus at the end of the year, and you get that for 1 year, and you want to buy a home. Well, you need a 2 year history of that bonus income to be able to use it. So if you just got that new job that's giving you the $10,000 bonus, well, you got to get 2 years of that before you can use that income for your bonus. Same with overtime, same with commission. If you work overtime at your current job and then you get a brand new job, and at that job you're also going to work overtime and you have a history of that, then you can use it. Same with a bonus. Your current job is in sales and you get a bonus, and then you get a brand new job and it's in sales and you also get a bonus, then you can use it. So, what we're looking for is stability and continuity with the different sources of income that you get. Self-employed. I run into this a lot with first-time homebuyers, where a self-employed person, or let's say they just started a new company because they were doing really well working for someone, and then they just started their own, and they're doing it, and they're doing great, and they're killing it, but they've only been doing it a year. Well, you can't actually get a mortgage yet. You have to have 2 years of filing your tax returns, and whatever you claim to the IRS that you made, that's the income that's able to be used to purchase a home. So that can be tricky. And if you do have complex income, it's not a deal breaker, but it does require clean documentation. And what they mean by that is if you switch jobs and you were getting bonus income at your prior job and you're going to get bonus income now, we might get something like your last pay stub at that prior employer that shows what bonus you had year to date at that employer before you switched. That way we can show you have bonus on your new pay stub and you had bonus from your prior employer as well. Okay, cash to close. Brandon was alluding to this before. So a lot of times people confuse the down payment and the closing costs because on some of the mortgage disclosures, all of them are lumped into actually the word closing costs. And not all of them are closing costs. So, for example, where it says closing costs here, that includes lender fees, title, escrow setup, prepaid items. Well, escrow setup and prepaid items are for your property taxes and your homeowner's insurance. Those are actually not closing costs. Those are just taxes and insurance, but they're all lumped in. So that can be a little bit confusing because depending on the home that you're buying, maybe it has really high taxes on that property. So that's going to boost up the amount of closing costs. And sometimes the consumer can think, gosh, why are the closing costs and fees so high to get this mortgage? And it might just be the property that you're buying. It also lumps in your down payment into it. So all of that's going to be your cash to close. So if you have to put 3.5% down, you also have to cover your closing costs. You also have to cover your first year of homeowners insurance. If you buy in an HOA, a lot of times they have some extra fees that you have to pay to move into that HOA. All of that's added together for your cash to close. In the very early stages of the process, Brandon and I are going to give you an estimate that's going to include all those things. In the beginning, we'll actually give you that estimate before you get under contract as well, but it won't be quite as dialed in. Once you get under contract, we're going to have those numbers finalized fairly early in the process. So you're going to know how much money you need to set aside for closing.
So, at the very beginning of the process, and these are terms that you've probably heard thrown around, a pre-qualification versus a pre-approval. And what's the difference? So, when it comes down to your pre pre-qualification, it's essentially a high-level conversation based mostly on what you tell me. I'm not going to review documents at a pre-qualification. We're kind of just going to go off of your word. It's good for very early planning, but it's not strong when you're ready to make an offer. When you're ready to write an offer, you're going to want what's called a pre-approval. Now, the difference is with a pre-approval, this means that we've verified your income documentation. The numbers are all verified. Underwriting logic is already applied. And it makes your offer much stronger and much more competitive because we can give the seller a pre-approval form saying, hey, we've reviewed income, assets, all documentation's good to go. We're ready to write an offer. And we have automated underwriting approval. And so this is something that agents actually take seriously. Um, I mean, a simple analogy is that a pre-qual is like estimating your budget essentially, and a pre-approval is like having your financing locked and loaded, ready to go. So um, the the early stages, are definitely okay as far as um, getting a good idea what you're going to be eligible for. But when it's time to get down to the nitty gritty, we're going to want to go through the full pre-approval process because that tells the seller, hey, they've essentially gone through a pre-underwrite, they're ready to go, and it'll help you close a lot quicker too. So one thing that I always like to bring up is that, you know, there are going to be a lot of documents that we ask for up front when we're doing a pre-approval. And so it's very, very necessary for you to know, hey, this is where I get my pay stub. If you have a payroll service that your company uses, you can log in and figure out this is where I download a pay stub or my W-2s are in this category. I know where everything is and keeping it nice and tidy helps speed up the pre-approval process and also helps, you know, give helps keep you from getting a huge headache in this process. Um, a lot of people, and this is a lot less common now, but it still happens all the time where their employer cuts them a physical check and so they might not have direct access to a website where they go get their um, pay stubs and things like that. So if you know that you're getting ready to start your pre-approval process, a good idea is to start, taking pictures of those pay stubs as you get them, so that we can collect a couple of those up front, so that when we go in to verify income, it's already laid out and it makes your process a little bit smoother. Um, the other thing is, depending on how you're paid, there can be some additional documents that we may have to gather. So it's always good to have a good idea, as to where to reach and gather all those documents.
Yeah, and the beauty with technology these days, it's a lot easier to get that documentation. I've been in the business long enough that when I started back in 2001, I remember that I'd have clients that have to mail me their documentation. So if they forgot to put one pay stub in there or they're missing a page of the bank statement, it took a week to get come in the mail for it, or they also would fax it. They'd have to go down to back then it was Kinko's, and they would send their fax, and then one of the pages would come out all black, and you wouldn't be able to read it, and they'd have to send it again. So it's nowadays you can just take a picture of things. So to Brandon's point, if your W-2 comes through the mail, just take a picture of it and put it in a file on your phone. That way you know that you have that handy.
Mhm.
Okay, how to shop a mortgage without the chaos. So, getting a loan estimate, the what's different from Brandon and I being mortgage brokers versus a Rocket Mortgage or a Bank of America or Loan Depot or any of these large banks or direct lenders that you might hear about. A mortgage broker works with a slew of different lenders, and we are considered wholesale. The lender works directly through us, and we place mortgages with these different lenders, and they all have different niches that they fill. Some are ones that specialize in working with veterans. Others work with the low credit score FHAs. Some work with the USDAs. Some work with the reverse mortgages. Some work with, different criterias. And the advantage for Brandon and I is we can shop those around and find the one that offers you the best deal, which would be the lowest rate with the lowest fees. That we don't get compensated more or less based on the lender that we use. So our interest is finding you the best deal with that. So not all lenders are the same. If you go to Rocket Mortgage, they only have their own products. They can't shop it around anyone else, and that's all they have. And the reality is, which you felt this since COVID, is everything's way more expensive these days. So Brandon and I are both independent contractors, and that means that we don't have the overhead cost that we would have if we had some big office building and tons of employees that we had to pay, or we're sponsoring stadiums in our names and things like that. The consumer pays for all of those. So these big name lenders really have a disadvantage these days. Although they have name recognition, they're far more expensive than you can get through a wholesale mortgage broker. And with us, again, we can do all the shopping for you. So you don't have to make 20 different phone calls. We can make the 20 different phone calls for you to find the lender that's the best fit. And with you, we're going to review the interest rate, the APR, which is the rate plus the closing costs for the loan. So when you compare mortgage offers, the APR tells you how much they're charging in fees. So if two lenders are both offering a 6% mortgage and one has an APR of 6.1 and the other has an APR of 6.4, well, the one with the APR of 6.4 is charging a whole lot more fees for their 6% mortgage. So even though they're both 6%, the APR tells you behind the scenes who's charging more in fees for that. And finding out what could you do to change the pricing for your loan. So let's say that you are getting a little bit higher interest rate than you would hope for, or like maybe the going rate right now is 6%, but you're finding that you're at 6.25. A good question is to ask, what do I need to change? Is it my credit score? Is it my down payment? What is it that I can do? And that's something that we can quite simply fool around with in our system to say, okay, if you get your score to this, it'll drop your interest rate to this. And like I mentioned, not all lenders are the same. So, yes, you're going to have the big name recognition with some of these ones that advertise all over the internet and have stadiums in their names, but they have less options and they have higher fees that you will get through than a wholesale mortgage broker. And they also don't have working hours that work well for purchase transactions. I hear this all the time with like the Navy Federals or the banks. Realtors hate working with them because they're open Monday through Friday from like 9 to 5. And real estate is not Monday through Friday, 9 to 5. It's typically evenings and weekends when people are shopping for homes and you can't get your lender on the phone. So, people like Brandon and I, we're working all sorts of hours, especially on the weekends, because that's when real estate's happening. And not all lenders actually specialize in purchases. Some of the big ones, and Rocket was mentioned in there, no bashing of Rocket, they're one of the biggest out there, but they're mostly a refinance company. That's their bread and butter, what they do. So, when it comes to purchases, you need a lender that's in communication with your real estate agent. And if you're working with a lender that's in a big call center, it's going to be really challenging, for you to be able to, get those to communicate with each other. All right, so here's the home buying process, kind of the typical journey for someone. The first step is going to be kind of prepare a budget for yourself. Where would ideally have your monthly payment fall? How much cash to close could you possibly save up? That kind of just come up with a general idea of how much money you can come up with and what you would like to have for a monthly payment. Then in the pre-approval process, we can help you determine the price range that you would need to be in to fall within that budget that you have. Then after you do your pre-approval, you'll start your home search after that point. Once you find a home that you like, you'll make an offer and hopefully get under contract. Once you're under contract, then you're going to do your inspection. And after you get through the inspection period and everything checks out, then we order the appraisal and we start the underwriting process for your mortgage. And then finally, when that's complete, you go to closing and you get the keys. So, inspection, like Brandon was alluding to, that's for you to do. It's not required by the lender. Basically, the inspection is going to tell you any costly repairs that you might have on the horizon. If going to, your roof that you have in the house that you want to buy is only going to be good for 3 more years. Well, that's a really expensive item. Or you have some plumbing components that are going to need to be replaced in 5 years. So these are things that a good real estate agent can negotiate on your behalf and help you be able to get the seller to cover those things, or make sure that you're not walking into a grenade, something that's going to be a problem for you later on. The appraisal is for the lender. And what that does is confirm the value of the property. Ultimately, that value is going to determine how much you can borrow. So if you get under contract for a house for $400,000 and it appraises for 375, then the realtor is going to negotiate on your behalf and get the price lowered because it's not worth the 400,000. So during the underwriting phase, when you are under contract and you've cleared the inspection and you're submitted in underwriting, you will have a series of document requests that you'll get. You really want to make sure that you have those things available, like Brandon mentioned, pay stubs, bank statements, W-2s, tax returns, and things like that. You want to have that stuff available that you can send in. You'll also have some documents that'll be sent to you via email to e-sign. Everything you want to move quickly on. That's just going to expedite the process for you and make it a lot less painful as well. During that process, you don't open any new credit cards, even for the 0% offer that you might get. You don't buy the furniture ahead of time. Please, no furniture ahead of time. I can't tell you how many times I have someone under contract. We're almost about to close, and they're like, I just went shopping for furniture. Is it okay that I put $5,000 on my credit card? Like, no, it's not. Don't do that. Yeah, just wait. Once you close and you get the keys, have at it, but not until then. And no, don't co-sign for anybody. Just don't do that at all. Like, even if you're not going to buy a house, like co-signing for someone is a really, really bad idea. That person doesn't qualify for a loan and you're putting your name on it instead. So, like, what could go wrong? Probably not a good idea. And don't move large amounts of money around. So, you don't want to have cash. You don't want to be depositing a bunch of cash. You don't want to move money from your money market into your savings account and your checking account. You got to document all those things that are happening. So you really want to try to avoid all that stuff. And when you get to closing day, you'll get something called a closing disclosure that it has to be received at least 3 days prior to closing. That closing disclosure is going to tell you to the penny how much money you're going to need for closing. You'll compare it to your loan estimate, something we would do with you, and then you can make sure that nothing changed as far as the rate or the fees or cash to close or anything that you might have questions on. And if you do have questions, it's always a good idea to make sure we address all that stuff ahead of time. You don't want to be signing papers and feeling like you have questions then. We want to address everything ahead of time so when you go to closing, it's a great, easy experience for you. And you want to bring the required funds the safe way. So your title company is going to tell you you can either have a certified check for the funds at closing or you can do a wire for them. So there's a couple of different ways that you can choose to get the money. You can't write a personal check. You can't bring them a bag of cash. So there's going to be some requirements for that. And then after closing, once you already have the keys, then you really want to be focusing on making sure you do have some money set aside in a reserve for maintenance and repairs because they are going to come. And you want to review that in the first year after you're in the home, after 12 months, that's when your escrow account will be reanalyzed and your taxes and insurance could possibly go up. And you want to keep your documents from your closing in a file cabinet or somewhere that you have readily available that you can refer back to so that you can easily see if anything changed. One thing about Brandon and I too, because we work with so many first-time home buyers, we're going to be in touch with you, especially when you reach that year mark and things like that. So, we don't just do the purchase for you and disappear. So as things happen throughout your home ownership journey, we're here for you to help. And then if you have PMI, again, this is something we will track for you. But if you have PMI, we want to kind of come up with a game plan of when that will fall off for you. And lastly, here, we're almost done. Some of the money saving tips. So, shopping with a mortgage broker, like we said, not only are we wholesale, we have lower rates, but we have a lot more lender options. You want to find out about different lender credits you might get versus paying points to lower your interest rate. You want to work with a realtor who does regular business with buyers. If a realtor sells a whole bunch of homes, but they don't work with buyers a lot, that might not be the best fit for you. You want to consider seller credits where they're allowed instead of a price cut to a home. Seller credits mean that they could cover your closing costs for you. That's out of pocket money. So that can make a really big difference for you for the cash to close that you have. And you want to budget early for your closing costs. Like Brandon said, typically in the 2 to 5% of the purchase price range is what you want to kind of have set aside. And finally, here, the stress savers that you have, you want to make sure you're pre-approved before you actually start touring. I can't tell you how many first-time home buyers start looking at houses on Zillow and they fall in love with houses first, and then they talk to a realtor and they get all excited. Then they talk to Brandon and I, and then we're like, well, this is what the payment would be. And then they're shocked. And no longer do they want that house anymore because they can't afford it. So you want to make sure that you find out first, what can I afford? And then look at home so that you have the right expectations.
It's a really good way to get discouraged up front is to
Yeah,
look at Zillow. And I mean, it's always a good starting point, right? Like, get a good idea of kind of where the market is. But, when it comes down to brass tacks, you definitely want to talk with us first.
absolutely. But I'll tell you, most people they get it wrong. They go to a real estate agent first because they're excited about buying a home. I totally get it. It's not fun to talk to a lender first, but don't you want to know before you start looking at houses which ones are actually in your budget? Because
That's
the
right.
payment that shows up on Zillow, it's not what your payment would be as a first-time home buyer. That assumes that you're putting 20% down and you have a 740 credit score. So that's not a lot of first-time home buyers that are doing that. So your payment's going to be higher than what it shows on Zillow. All right, Brandon, you want to take this one?
Yeah. So, these are common mistakes to avoid. These are things that we've run into time and time again. Like Pete just mentioned, falling in love with a home before you know the numbers. Like I said, that's a easiest way to get deflated in the process and kind of shoot yourself in the foot up front. You want to make sure that you know the numbers before you fall in love with the home. Calling a real estate agent, going to view a home, absolutely loving it, just to find out that it doesn't fit the budget. It's like the nail in the coffin. So don't do that. Again, confusing down payment with cash to close, like we mentioned a couple times, two separate things. And again, the seller, and especially in a market like we're in today, can help contribute vastly towards your closing costs. Your down payment, you're going to have to come up with, but we want to make sure that we have reserves and enough to cover both if it comes down to it. Again, big ticket items, buying a car, appliances or furniture during the home buying process are things that are just going to hurt you in the long run. Once we pulled your credit and we have your loan structured, you definitely want to wait before you make any changes, even if it's something as small as, let's say you have a credit line on your credit card of, $1,000. They call you and say, hey, you've been making payments on time. Everything looks good. Let's go ahead and increase that limit to $2,000. Something as minor as increasing your balance or your limit, it can affect your qualification. So we definitely want to avoid doing anything like that in the home buying process. Like I mentioned before, ignoring inspection findings or underestimating repairs. This is one, I actually just had a first time home buyer go through this process. They had a family friend who does roof repair and things like that, and they're like, "Oh no, it's okay. We're all right. My uncle's going to come in and repair the roof." Well, uncle gets in and finds out that it's a lot more work than anticipated, and now they're stuck in this house, and the roof. We just had all this rain, and now they have a leak, and it's just one thing after another. And this is something that could have been avoided had they had a proper inspection and gone through the proper channels to make sure that those repairs were going to be within reason. So um, the other thing is, like we talked about, you definitely want to shop with a mortgage broker because they're going to be able to lay out every single option that's available to you and be able to shop those and find the best deal for your situation specifically versus just kind of a cookie cutter. One product does not fit all. So if you're going with one lender, a lot of times you can get bottlenecked into something that doesn't help your scenario at all. So that's where being able to shop these different lenders and find the best fit for you is going to really help you, especially as the first time home buyer, get into the right product and the right program.
Yeah, Brandon and I obviously would love you to work with us, but we keep hitting on this point over and over because just as a consumer period, I would recommend that even if you don't work with us, you want to work with a mortgage broker. In my 25-year career, I've worked at literally every type of lender out there, banks, credit unions, direct lenders, retail lenders, worked at all of them. And there's a huge difference. I mean, it's
Mhm.
a huge difference between those big name ones. You're paying considerably higher interest rates and fees. So you do definitely, whether it's us or someone else, you want to work with a mortgage broker specifically and realize the difference of a broker versus a direct lender is that that broker, we're not an employee of the lender that we place your mortgage with. And it gives us kind of a leg up in working with them. They're kind of our customer. So if they don't treat our clients the right way, we don't send them any more business. So they're really working hard to make sure that we can give they're going to give us the service that we want and give us the pricing that we want so that we send them more customers. So they're really kind of vying for our business that helps and that helps you as a consumer.
Yeah, and a lot of times if you're looking at three different lenders, like let's say you get a pre-qualification at your local bank and then you get one through a big call center and then you get one through someone else. Well, now you've spent 3 full days probably on the phone talking through these different scenarios, doing applications. Whereas with your one application with a broker, we take that and we can present all three options. So we'll show you what that lender, a lot of times, and this is crazy, as a broker, we can take a loan to like let's say uh, United Wholesale Mortgage. If you went directly to that bank and tried to find, or let's say Freedom, that's a better example. Go to Freedom, you could apply through their website online. You're probably going to get worse terms than if you were to go with us because we have wholesale pricing. Um, so even if you go directly to that lender, I've seen it time and time again where we can actually get you a better deal on our end going to the exact same lender. So broker 10 out of 10 times is a better option.
Facts. Yeah. All right. Thank you for your patience here. We won't keep much more of your time, but if you have any additional questions, now's a good time to put them in the chat. And we'd be happy to answer them for you. Also, kind of the goal here for the next steps would be to set up a one-on-one consultation with you. Obviously, no obligation. The process for a home buyer is not like we're trying to get you to buy a home this week or something like that. It's going to take some time, and we totally get that. We want to help you through that process, even if it's a year from now to do it. We'll help you along the way to be prepared. Most first-time home buyers we're doing loans for, we've been working with them for a long time. So don't feel like it's you're bothering us if we have a conversation now and it's not going to be a while until you can actually buy a home. So yeah, we'll be reaching out to you to touch base. Brandon will be calling specifically and texting, things like that. So we'd love to, connect with you and kind of find out what's your motivation in buying a home and how we might be able to help you. Oh, thank you, Miriam. We'll look forward to chatting with you. Hope you guys got a lot of good information out of this. Um, yeah, so in that one-on-one call, we'll kind of talk about your specific situation, review your credit with you, talk about loan options, talk about your goals, your job, your finances, all the things that you might need so that you have a good idea of what to do next. So there's our email addresses if you want to jot them down. Otherwise, you got our phone number. And thank you for being so patient this evening and listening to us chat. And we hope that you have a wonderful night. Thank you so much.
Thank you all.
Good night.